The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello, good evening, and welcome to this edition of our Become a Pro course presented to you by Robert here at Forex.Academy. Of course, today, guys, we'll be discussing portfolio diversification. We are getting our way through this Become a Pro course towards the end now, with a lot of fundamental and technical analysis aside in our arsenal of education. Of course, we'll be looking forward to diversify away some of these risks via portfolio diversification. So do look forward to today's lesson. Very, very educational indeed. Now, before we begin, of course, please take a moment to read through the following disclaimer. You can pause, obviously, the recording if you're going through the recording at a later stage. Please note there is inherent risk when trading the financial markets. And just a few pieces of housekeeping before we begin. Of course, feel free to ask questions throughout. It is a free, of course, live interactive webinar. You can, of course, ask questions on screen. I'll be able to see them. You have a chat box there located on the right hand side of your Windows Explorer there, of course, with the GoToWebinar function, and you can ask questions throughout. I will be able to correspond with you throughout the webinar. This live webinar is being recorded and will be placed into your members area once we have concluded. So if you could just give us a grace period of 1 hour, you'll have it for revision purposes within your members login area. And we will be hosting an extended Q&A session at the end of this live webinar, just to deal with some of the main topics of today's course. Okay, so we are now at week 4, of course, of the Become a Pro course, getting our way through, of course, with a lot of technical analysis, as I said, a lot of fundamental case studies on sector analysis, supply and demand, market forces, different ways to analyze the markets. This week we discussed market correlations, risk and risk aversion as well, and that leads us nicely into looking at portfolio diversification. Okay, so now that we know that some markets are correlated, we know that there are many, many different asset classes and markets that are not correlated. So that allows us to look for different opportunities across different asset classes and markets, whilst spreading those risks inherently across different asset classes as well. So we'll look at how to spread those risks through diversification, how to develop short, medium, and long-term portfolios as well, okay? And then, of course, we will go through developing a profitable trading strategy tomorrow with our ultimate Become a Pro lesson, of course, there at the same time. Okay, so first question we'd like to pose to our audience here is, what is diversification? Have you heard of it before, guys? Have you heard of diversification? Have you heard of portfolio management or portfolio diversification as well in terms of financial circles? Well, let's go through it together. Diversification we define as the mitigation of inherent market risk via asset allocation, okay? So there is risk inherent in the markets. Now, that inherent risk is different to your stop loss or traditional risk that you may think. Inherent risk is more systemic risk in terms of trading. So let's say we are an equity investor and we are long the markets. We have shares in Google, in Microsoft, and some well-performing companies. Yet overnight, there is something happening in the overall S&P function, or perhaps there's conflict with the United States or a terrorist attack, something that may rock markets. And of course, the markets open lower the next day or after the weekend. That is a sort of systemic inherent risk in holding asset classes or trading financial markets. The search for opportunity over a wide range of financial markets. Okay, that's what we're looking to do in terms of diversify. So we're looking not only to mitigate risk, we're looking to look for more opportunity across a wide range of different asset classes that are uncorrelated. It is the implementation of an investment or trading strategy that aims at seeking an expected level of performance, i.e. alpha. Okay, so we call that alpha. That means that you're looking to develop an expected level of return, perhaps in investing or trading bonds, stocks, equities, or perhaps indices or commodities, whatever the makeup of your portfolio relative to the return or expected rate of return you're seeking. And it depends on the objective, of course, for each individual trader. They aim to secure return as a sustainable long-term financial model, no matter the environment. Okay, so no matter the current sentiment or the current market risk theme or the environment, of course, you're looking at delivering a return. So what I have mentioned here is hedge funds and pension funds. So we'll take pension funds as an example. They effectively have portfolio managers looking to diversify away risk, and they trade all asset classes, getting heavily involved with large positions in these asset classes. Now, as the setup of a pension fund, really what it has to deliver is a rate of return for its trustees or for its pensionees, of course, so that those who have been working for 20 or 30 years will have some income, i.e. a pension after their work life. Okay, so they're investing in the markets to beat the market so they can deliver a return on investment, so that they can trickle that down, of course, and deliver a return in terms of pension to the workforce. Okay, so they need that to be a sustainable long-term financial model. They need to be able to deliver that return no matter the environment, of course. If somebody is working for a company over the course of 30 years and they have then a pension after that time period, of course, during that 30 years, there's going to be many different financial cycles and business cycles. That firm, the pension fund or trust fund of that firm that's trading the markets over that time, will have to deliver a strong return to be able to pay out these pensions. Okay, so that is that's one key aspect to diversification, building a sustainable long-term financial model to deliver return. Portfolio selection. Okay, so what is it? Well, it's a study of how people should invest their wealth optimally. Okay, portfolio selection. So market selection we discussed. What about portfolio selection? How does that differ? We're looking for optimal results from the amount of risk that we can take on. A process of trading off risk and expected return to find the best portfolio of assets and liabilities. Okay, so we have some narrow and broad definitions: how much to invest in stocks, bonds, and other securities, whether to buy or rent one's house, say for example, what types of amounts of insurance to purchase. So these are all an assessment of risk. Okay, broad definitions across different landscapes, of course, but you're trying to deliver an optimal level of wealth or save from that liability or risk asset. And of course, how to manage one's liability with how much to invest in one's human capital. Okay, now there is of course a rationale for portfolio selection, and it does touch upon what we discussed in terms of rationality in trading in the previous lesson. The rationale for portfolio selection is a curve. Now, doesn't that look similar to us? It is in fact the curve in terms of the preferential trader who is more risk preferential in terms of accepting more risk, and of course is looking to follow the curve. You're going to have a low level of risk within this band here that is going to deliver a certain level of return. Here is the medium or equilibrium price here, of course, in terms of the amount of risk for return here. So this is what most of us, in terms of economic agents, what we aim to go for. Of course, the more risk we are looking to take, well, why would we be taking more risk? Because, guys, this is the function of risk and return. We are looking to develop a high level of return from that added element of risk. Okay, so effectively that is an ongoing cycle, ongoing thought process for us as financial traders. Okay, so let's discuss then risk tolerance. Okay, because we all have our own appetite for risk. I know I was speaking to you with some Q&A questions towards the end of the final few webinars there, and we discussed that we all do have different appetites for risk. Some of us are more risk averse, some of us have more preference to risk taking. Risk tolerance is a major determinant of portfolio choices. Okay, risk tolerance. So again, pension funds, perhaps they don't, or hedge funds, perhaps they don't operate only one single risk function. They may have three different portfolios, one looking to provide sustainable returns at a very low risk, so perhaps it provides something like 3 to 4% growth per year, very, very low risk, just above something like a bond market. Of course, something might be aimed at delivering a return of around 14 to 20% annually. that is going to be more of a risky portfolio in terms of asset selection. It is influenced by such characteristics as wealth, expected return for individual or trustees, and the current market environment and the time horizon of the portfolio. Okay, and the time horizon is significant for us as traders and investors, which we'll discuss throughout this webinar. Question I would like to ask here, guys, is there such a thing as a riskless asset? Okay, when we discuss risk tolerance, is there such a thing as a riskless asset? What do we think, guys? Well, a security that offers a perfectly predictable rate of return per unit of account invested. Now, what does that mean? Well, unit of account, that's your wealth, your capital, your money, and the length of the investor's decision time horizon. For example, if US dollars are taken as a unit of account and the decision time horizon is 5 years, the riskless free rate as regarded by capital markets, guys, that we discussed in previous webinars, is that of the 5-year United States Treasury bond, of course, a more, I suppose, applicable of US capital markets. So the 5-year riskless free rate of return, we look to the bond market because they are very likely, of course, to pay back their loans or their debt instruments. And if that return is delivering something like 2 to 3%, that is what we regard as the riskless free rate of return in capital markets. So let's go through this with a little bit more functional discussion on risk and time horizon itself. Well, required returns depend on the risk of the investment. We know that. Okay, so the greater the risk, the greater the return, and we call this risk premium. So what is the risk premium to perhaps an ETF following the oil market? Perhaps this ETF follows shares in Total, in Chevron, in BP, in Royal Dutch Shell, and in the commodity itself. So that's an ETF. It's following different applications to the commodity itself. That will have a risk premium of, say, 7%, okay, or 17%, something that can try and outpace the commodity growth itself. Okay, so we need to formulate a plan just like the ETF does in terms of our portfolio selection. Okay, in formulating this plan, you begin by determining your goals and time horizons. Okay, so let's walk through some of these horizons that we may need to take into account. Planning horizon, i.e. the total length of time for which one plans. Okay, so we need to plan our portfolio. What sort of return are we looking for? Let's start to plan. Decision horizon, the length of time between decisions to revise the portfolio. And of course, that may be in terms of mitigating risk, which we discussed in the previous webinar. It may be in times of adding a new asset to your portfolio, so revisions to the portfolio. Trading horizon, the minimum time interval over which investors or traders can revise their portfolios, its determination and impacts. Okay, in with the current risk environment, of course, the minimum time interval over which can reassess our portfolio given its impact. Okay, and last but not least, the investment strategy and trading horizon. And this is the portfolio insurance or dynamic portfolio strategy. This is going to be your own strategy behind your trading portfolio. Okay, now I know, guys, some of us might ask as we go through some of this webinar, well, for me, Robert, I kind of trade the markets intraday. I look to scalp the markets, I swing trade the markets. This might not be as applicable for me as other webinars. And I get that, guys. Some of us might have a different deliberation on our trading strategy. However, I'm going to go through many examples here to tell you why that's not the case. Why that even as a small term trader, when you get more and more experienced, you're going to know how the markets start to operate, how capital markets move with trade flows and depreciating currencies, carry trades across currency pairs, how that affects other markets, and you will inevitably at one stage or another look to take a long-term trade. Now that might be the case, hopefully for most, if not given, we've went through a lot of education here during the Become a Pro course. So let us answer that question as we go through the webinar. So there is a trade-off, guys. Okay, there's a trade-off with expected return to risk. The objective is to find a portfolio which offers investors the highest expected rate of return for the degree of risk they are willing to tolerate. It's always about tolerance, okay? Risk acceptance. As individual traders, we should assume the same strategy for our medium to long-term hold carry trades. Now we're getting to it. This is often a two-step process. Finding the optimal combination of risky assets and mix this optimal risk asset with riskless assets. Okay, so that is effectively going to tailor a function in terms of expected return to risk. Let's say we have a function of 10 markets to trade long term or medium to long term. We choose 7 single stock equities, okay, and they're perhaps let's say they're in the not one of the main markets. We'll choose the FTSE or we'll choose the UK to invest. But let's say there are 7 single stock equities in AIM, which is the alternative investment market there, a small share market share cap equity index that we follow there in the UK. We choose 7 risky stocks in there. Some of them will of course outperform, some will show a lot of volatility of course, and then we'll choose the FTSE 100 itself, of course, as a level of gauge of sentiment in the UK economy. And then for our other 2 markets, we'll choose the oil market and we'll choose the gold market, okay, as perhaps an inflation hedge. So we have a few risky assets, we have quite a few risky assets and some not so riskier assets across our portfolio. How does that, what sort of alpha are we looking for that to return? What sort of return can we expect from that sort of portfolio? Well, let's discuss the case for diversification, okay? Financial trading offers the chance to profit from movements in foreign exchange, commodity, equity, and bond markets, but with visible inherent volatility and risk. So we know it's always there, it's visible, we can see it day by day, the volatility in the markets and the risk involved. As risk-averse economic agents, and again we discussed this in the last lesson, we all aim to seek the best return from assuming the least risk. Diversification provides us with risk mitigating opportunities via risk spreading. Okay, so we look for these opportunities to spread risk across different assets. Okay, does that make sense, guys? If we're trading 10 markets, let's say they're all forex pairs and they're all in the US dollar, long, short, short, long, of course, they're going to be interconnected, i.e. correlated, and we're not effectively spreading risk through asset allocation. Diversifying your portfolio makes you less dependent on the performance of any single asset class. And then the dollar is a good example there, which we'll discuss. Effective diversification requires combining assets that behave differently when held during changing economic or market conditions. Moreover, investing in assets that have dissimilar return behavior may insulate your portfolio from major downswings. Okay, so we're looking to protect ourselves while looking for opportunity. That's the key there. So how can we do so? How can we look for opportunity whilst trying to protect ourselves? Well, we have a dummy portfolio, I suppose, here. And the first thing we'll just go through is the actual the markets traded, okay? So you can see here we have dollar exposure, which is quite substantial. So what we're trying to do with this particular trade is to gain dollar exposure. Okay, we're trying to gain dollar exposure now. Let's go through some markets that we've chosen. US oil. Okay, so it's traded in US dollars, of course, and when you see upside in this market, it does promote a level of growth, commodity growth within capital markets. So we've chosen to go long, quite a substantial move there with our trade size long the US oil, WTI oil market. Okay, so we have some exposure to the dollar, albeit it's in a commodity, so it's relatively small. Natural gas as well. We see this trade as moving strongly to the upside, following the trend, and again trying to gain some dollar exposure in the commodity markets. Okay, then we have a long US dollar CAD trade. Okay, so that is effectively a bit of a hedge against our US oil trade, because if oil starts to increase, we're likely to see, traditionally, we're likely to see the US dollar CAD trade to the downside, because it mitigates itself, because obviously the Canadian economy, it runs very, very reliant and is very exposed to oil prices and is supportive of the loonie, i.e. the Canadian dollar. So we see a level of hedge there. But then, guys, we are effectively taking our exposure here in the dollar index. We are long the dollar index with a 0.10 trade size. Okay, so that's our big dollar exposure trade. Then we have some uncorrelated assets, so we're actually trading the Australian Swiss franc, we're trading the Canadian Japanese yen, we're trading euro dollar again, but we are short the euro dollar, so we're trying to capture again some movement in the strengthening dollar. Again, guys, Bitcoin, which is priced in US dollar, will play a factor. We're actually short that, so we see a bit of a hedge, and we believe that the dollar is, indicatively showing strengthening signs of economic growth. So let's try and get involved then in a carry trade here with the Nasdaq 100, albeit relatively small trade size. Okay, so that is effectively what we're doing. We're trying to gain dollar exposure. Now, with our portfolio, we can go into our asset allocation. We can see it's well spread out, but we can see we have effectively gained dollar exposure. That is the task at hand. That is what we want to do in terms of our volume. We are gaining that dollar exposure there, okay? So effectively, this is our heat map. You can see we've gained the dollar exposure, but let's go through the markets in question. And again, are there methods to gain exposure whilst mitigating our hedging risk? So let's go through. What we have is again, you can see here, I'll just go back. You can see our dollar trades here. We've effectively gained that exposure across different markets in the dollar. Then we can see how we're trading this market. So we have some low correlation with the dollar itself, with the US oil and natural gas market, albeit they're priced in dollars, so you might see some movement. We have our exposure trades with the dollar CAD. We have the US dollar index again, an exposure trade here, and the exposure is the euro US dollar. So that's the currency trade. However, let's go back to the dollar index, guys. We have a hedge with Bitcoin, so we're gaining exposure with the dollar to the upside. Bitcoin is priced in US dollars, and when you see this start to trade down, of course, you're going to see that level of hedge correct itself. And again, the Nasdaq 100 is going to see a hedge effect, given we believe one of the reasons the dollar is strong is because interest rates are starting to increase, okay, in the US, and that is evidently leading into economic strength there in the equity indices again. So we're trying to follow that momentum in a totally uncorrelated asset. Okay, so we have tried to gain a level of exposure here across the dollar. Again, let's discuss the case for diversification, or for diversifying across different asset classes. Now, what do we see on stage here? What do we see with this particular chart in front of us here? Well, we see we are trading a return over a 10-year period here, illustrating the annual returns for 3 different portfolios over a 10-year time period. Okay, stocks represent, I would say, 100% of the investment in large stocks. Bonds represent a 100% investment in long-term government bonds. And when the stock and bond asset classes are combined into an equally weighted portfolio there, that's the 50-50 portfolio we see in the middle, the portfolio experienced less volatility than stocks or bonds alone. Can you see that, guys, by observing the chart? Just the gray line experiences less volatility in terms of return. Okay, notice that stocks returns were up at times when bond returns were down, and vice versa. Hence the traditional relationship between stocks and bonds, which we've mentioned, guys, between various webinars in the Become a Pro course. Okay, so we do see that traditional relationship playing out. We have an offsetting effect then, with these movements assisted in reducing portfolio volatility. Again, another word for our portfolio volatility is portfolio risk. Okay, so that's effectively what we've seen there with the 50-50 split. Now, we know again that diversification does not eliminate the risk of experiencing an investment loss, but what we're effectively doing here in trading these different asset classes is we can gain a higher level of exposure. We could effectively take 3 portfolios on board, one being a high risky portfolio in only single stocks, which is the blue line. Again, we're hitting highs here. We hit a low, which is minus a very poor performance, of course, there in year 5. But again, we're seeing very strong performance here in other years. Again, we're seeing a level of volatility across the bond markets again, but seeing some very good returns, yet not so good returns in other years. So we can choose, each of these portfolios to adapt our own level of risk. We could perhaps use a hybrid approach and trade smaller size in all of these different portfolios, and effectively look to run them over a a series of alpha. So this is the case for diversification. Effectively, you can see with the 50-50 split, the compound annual return here is 7.9%. It's actually outperforming the stocks over the 10-year period, and it's outperforming the bonds at 6.1% over the 10-year period, actually using a 50-50 ratio there in these two asset classes, even though they move in opposite directions with traditional relationships at times in place. Okay, so let's go across the equity bonds risk versus return sector and discuss. Okay, so what do we have on screen here? Again, we have an efficient frontier with this curve effectively representing every possible combination of assets that maximizes return at each level of portfolio risk and tries to minimize risk at each level of portfolio return. Okay, so here on the left we can see the level of return. Okay, so we have a peak there of 12% return, and again the maximum risk portfolio is 100% stocks, just like our last diagram. Of course, we effectively are able to deliver that return, but again, that is at the peak of performance. Okay, so that's at the peak of performance. Well, the bond markets effectively are at a peak, say, delivering with this inflection 100% bonds, a 9% return, okay, on investment. So we can see different mixes in the middle. What does that tell us? Well, it tells us an efficient frontier represents every possible combination of assets that maximizes return at each level of this portfolio risk. Okay. An efficient frontier is the line that connects all optimal portfolios across all levels of risk. So guys, then we can choose which level of portfolio or which level of risk we would like to choose, which suits us as a trader. An optimal portfolio is simply the mix of assets that maximizes portfolio return at a given level of risk. This illustrates an efficient frontier for all combinations of two asset classes, stocks and bonds. And again, well, what is effectively our efficient frontier here, guys? Can we pick it out on the chart? James says it's right here at our minimum risk portfolio. Absolutely, this level right here is effectively 32% stocks, 68% bonds is our efficient frontier peak for these two investment portfolios. That's effectively the best mix for whatever complex area of stocks and bonds we have in this particular portfolio. Okay, so we're actually taking 10% risk there, 10% risk, and it's delivering 10% return. So that's fantastic in terms of stability for us. What else does it say? Well, although bonds are considered less risky than stocks, the minimum risk portfolio does not consist entirely of bonds. Okay, minimum risk portfolio does not consist entirely of bonds. We can see it has 32% stocks. The reason is that stocks and bonds are not highly correlated. That is, they tend to move independently of each other, and sometimes stock returns may be up while bond returns are down, and vice versa. These offsetting movements help to reduce overall portfolio volatility risk, which we explained. Okay. As a result, adding just a small amount of stocks to an all bond portfolio actually reduces the overall risk level of the portfolio. So do we get that, guys? See the fact that we're taking 100% bonds there, 12% risk, delivering less of a return, while we include a little bit more risk, actually reduces the amount of risk. Okay, a little bit more in terms of the stock side, reduces the amount of risk with our efficient frontier and delivers a little more return. Okay, so that's effectively what we want. However, including more stocks beyond this minimum point cause both the risk and return of the portfolio to increase. So that is the effective level portfolio managers look to aim to accomplish. Okay, that is our objective as traders and portfolio managers.